Hello investors, welcome to one more monthly interaction with Canara Robeco Equities team. There are three aspects which are key in the current context for equities in India. One, of course, is what is happening with the geopolitical conflict and how are we looking at it. Second, the earnings season, how the earnings season has gone by, which is fourth quarter financial year 26 numbers as well as the whole year numbers, and how's the trajectory. And lastly, how the valuation and view is on market. Let us start them one by one. Of course, in the current context, and as we have been discussing for last 2 or 3 months, this geopolitical conflict and the impact of it through the energy channel is the most critical event for us from both underlying economic activity perspective as well as the equity market perspective through the impact of this on the corporate earnings. Right from the beginning, our base case has been the event is likely to be short-lived. While we were expecting that it will get over in a month or two, it has stretched, but there has been intermittency in terms of how event has happened. Lately, there have been more number of basically ships which have crossed the Hormuz Strait. There is of course a lull within this activity. All the activities that are happening behind the basically curtain seems to indicate that at some point in time or next few weeks we will have a final deal. Either ways, either we will have a final deal or we will again get into a conflict. But clearly the momentum in terms of the escalation seems to be coming down over last 4 weeks rather than going up since we spoke last time. And it clearly is reflected in the way oil prices have reacted. The oil prices last time when we spoke a month back were hovering around $110, $115. From there already the energy market is indicating the same as I said, and the energy prices are at roughly $92, $93 as we speak. So energy market is clearly indicating that there is a gradual settlement and normalcy of the event that is most likely. We are working with that base case for last 3 months. We continue to work with that base case that you will have this event behind in few weeks times or a month's time. As long as it doesn't stretch beyond 6 months or a year, I think the market will see through it. Market will again start focusing back on the earnings. That's one. Clearly, there is a downside risk that if this event were not to get closed, you're going to have significant impact on both macro and micro. Assuming that this event sustains for a year and oil remains at $100 for a year, you're going to have current account deficit doubling from 1% to 2% in financial year 27. You already have FII flows which are strongly negative. The FIIs have sold roughly $20 billion of equity this year just in the first 5 months, which they sold for the whole of last year. It also means that the fisc will not keep improving, or fisc will actually get diluted a little bit from whatever numbers around 4% which are expected for financial year 27 to probably anywhere between 4 to 4.5% because government will have to support of non-passage of complete energy prices as well as fertilizer subsidies and gas subsidies. So clearly from a macro perspective, fiscal current account deficit and the balance of payment, because the CAD will increase and balance of payment has been a challenge because of the flows, will become a sizable worry as the time passes, and that's well reflected in the currency. Our base case still is that a lot of it is already reflected in the way our currency has behaved. Nonetheless, this still remains a meaningful risk to the Indian market if the conflict were to continue for a year or so. Not only macro, this event through energy prices will also start percolating into the earnings, and thus if the event were to persist, you are going to have both impact on the volumes across the sector as well as impact on the margins, and thus the corporate earnings can get basically downgraded anywhere between 3 to 5%, assuming that this sustains for a period of a year. So this is the downside of the event. Having said that, again, the base case with which we are working is that the event will largely be over by June, given where the status of the talk is. And as that happens, while there will be intermittent macro impact, the market is more likely to see through it because the event will be behind us. So that's on the Iran conflict side, Iran-US conflict side, and its impact on India. Second, and of course, that's the corporate earnings. The corporate earnings have been playing out as expected. The corporate earnings have been improving through the year. For the fourth quarter, the large caps actually delivered roughly till all the numbers which I have reported as of now, almost 90-95 companies out of 100 companies, 12% of earnings growth. For the small cap, the earnings growth is 19%, and for the mid cap, the earnings growth is upwards of 30%. Of course, in small caps, there is a base effect, and that's where you have to adjust for that. But nonetheless, the earnings trajectory has been better for the quarter. Even for the Nifty 500, the earnings is 12% YOY growth. Clearly, the earnings throughout this year have moved from low single digit of 4-5% to in third quarter of 10% to 12% for the BSE 500 or Nifty 500, as I alluded to. So clearly, the earnings trajectory has been improving through this year as an outcome of which we have repeated multiple times, the consumption boost that the government gave last year, both state and central governments. Second, the liquidity boost that RBI gave by keeping the liquidity in surplus. Third, the credit growth improvement, which was hampered last year because of the tight liquidity. And fourth, generally, the inflation, which has been coming up from the low levels. Of course, inflation can be looked at in the other way also today. It could also pose a risk if the Iran conflict stays here. But nonetheless, because of those 3-4 reasons, the earnings growth for the last quarter for the broader index, which is Nifty 500, has, of all the companies that have reported number, roughly 85 to 90% have already reported numbers, come to about 12% YOY growth. Clearly, cyclically, earnings have recovered. It only actually strengthens the argument that we have been making that in financial year 25 and part of financial year 26, we were in a cyclical earnings downgrade. There were no structural issues, and that cyclical earnings growth had actually revived. Unfortunately, the war is around, so intermittently we are again likely to get impacted in the first quarter. But if the war were to get over quickly, financial year 27 should be relatively more healthy year in terms of earnings growth. As of now, the consensus has still penciled in about roughly 14-15% earnings growth CAGR for next 2 years. But of course, it is contingent on for how much time the energy prices remain elevated for India. So that's the second aspect, which is how the earnings have played out. The valuations, of course, have corrected. Valuations have corrected significantly in March, and then they have come back. But when we look at the valuations from a statistical perspective, large caps are trading at roughly 17.5 times or 18 times 1.5 year forward earnings, which is a very, very fair or reasonable valuation or cheap valuation. That's in line with the last 10 years valuations for the large caps. The mid caps and small caps are trading at upwards of 23-24 times, which is statistically still expensive. But if you take the context of particularly mid cap, the earnings have been very, very healthy. Even when the large caps and small caps suffered in terms of earnings over last 6 quarters, before this quarter, mid caps continued to deliver. Of course, there is a nuanced reason for that. We don't want to get into it, but the mid caps have continued to deliver the earnings, and that's where they are a little more expensive. The more important point, apart from just statistical valuation and how they are faring versus their own historical numbers, is that today the earnings built up, the margin built up is far more reasonable across whether it is large cap, mid cap, small cap. There is no exuberance built in terms of numbers like it was 18 months back in the middle of 24-25. So today the earnings estimates are far more benign for most of the categories, except probably mid cap, which would be relatively on the higher side. For large caps and small caps, the earnings estimates are built closer to 15% or closer to 15% by the consensus. So that's on the valuation. Given this, as we have been saying, given the cyclical recovery in the earnings and given the sideways market for last 2 years, this uncertain period looks like a good opportunity for somebody who has a 18 to 24 months view. This is nothing new. This has been the case with most of the events. This event, of course, is little more peculiar, but our base case is even this event will pass quickly. And as this event passes, this will again in hindsight look like an opportunity 12 months down the line or 18 months down the line. For most of the events for last 20 years, whether it is GFC, whether it is the Fragile 5 challenge for India, whether it is European crisis, whether it is the COVID, whether it is the Ukraine-Russia war, all these case studies show that typically this kind of volatility on downside, and there is a possibility given the event in which we are, that we are likely to continue to have this volatility till the time this event persists. This typically present good opportunities for anybody who has a little longer horizon in terms of his investment. So anybody who's a serious investor should continue to actually think of his equity allocation and kind of realign it given the uncertainty that this event presents. That's largely from our side. Of course, the risks to market still remain, that if the energy prices were to remain at $100 or more, you might actually still have earnings cuts. You might still have macro which deteriorates, and you might still have a market which remains sideways. That's one risk. Second is, of course, the risk which is new on horizon, that this year the monsoon is likely to be at 90% of average. Not that the 90% of average monsoon matters. What matters more is distribution, and that's where would rather wait and watch how it plays out. If it plays out in a heterogeneous matter, then it will be a risk. But if the rain distribution is good across the 36 divisions, then it might not be as bad as it is projected, given that last 2-3 years, generally, the monsoon was above average and the water tables are good across the country. I think that's largely from our side on the market. From our portfolio perspective, we continue to play our base case that our portfolios are actually aligned to play the cyclical recovery, and thus the financials, the consumer discretionary, part of industrials, pharma, telecom, predominantly the domestic oriented sectors are the sectors where the portfolios are overweight on. FMCG is another sector where we have gradually added. IT we have gradually added more as just a tactical valuation play. But the commodities and oil and gas remains underweight. IT still remains underweight. FMCG still remains underweight. But there has been a weight addition to FMCG and IT to some degree to take advantage of the valuations where they are trading now. So that's largely from our side. In terms of themes, the recovery in NII growth in financials, the capital market plays, the superior growth of NBFCs, that is the financial part we are playing. The transmission and distribution and cables and renewables in the industrials and in consumer discretionary, new age quick commerce companies, as well as some of the other platform companies, as well as some of the other retail companies. That's what themes are represented in the portfolios. That's largely from our side for the month that has gone by. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.